Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Mathew. Like the name suggests, this show gets you actionable insight on everything mutual fund related, whether that is the concepts that go into the right kind of investing in mutual funds, or in fact, a check of how the schemes that you're invested in are performing. And that last topic is what we're going to focus on today. Joining me in the first half of today's show is Piyush Gupta, Director, Funds Research at CRISIL Market Intelligence and Analysis. Thank you so much for joining in today, Piyush. And we're talking about your latest report, which has a ranking of mutual fund schemes in various categories. And I want to focus on 4 categories, which is large cap, mid cap, small cap, as well as Flexi Cap, because I think that covers most of the industry. But let's start with large cap. And before we actually get into the top rankers, could you very quickly reiterate the basis for the ranking that you do?
Yeah, hi Alex, good afternoon. So this is a ranking that we publish on a quarterly basis. Today we are going to talk about equity as a category. So I'll give a broad overview of the framework or the parameters that we consider for the equity funds ranking. There are 5 parameters that we look at, starting from performance, which has the highest weight in the overall ranking, followed by volatility to measure risk in the portfolio. Apart from NAV-based parameters, there are 3 portfolio-based parameters we typically look at. This includes diversification at company and sector level and liquidity of the underlying portfolio. All of these factors are combined together to arrive at the final ranking within the universe. This is a relative ranking, which means that top 10 percentile typically are ranked 1, while the bottom 10 percentile are ranked 5, rank 1 being the highest. Yeah. And then 2, 3, 4 is looking at next 20 percentile, middle 40 percentile, and the next 20 percentile in the overall universe.
Fantastic. So in today's conversation, Piyush, I would like to focus on the top percentile and the bottom percentile. Let's talk about large cap funds. And there are a couple of names that are very well known in the large cap category that are at the top of the list, which is ICICI Prudential Blue Chip Fund, which was ranked 1 in the previous quarter that you ranked, and also is ranked 1 this time around, and Nippon India Large Cap Fund as well. JM Large Cap also makes it to that list, all 3 of which were ranked 1 in the previous quarter as well. What's working for these schemes?
Right. So when we look at ICICI Prudential Blue Chip, so this is a fund which has consistently been ranked 1. When we look at the historical ranking, it's ranked 1 for the last 4 consecutive quarters. When we look at the parameters where it has fared well, it is ranked 1 on performance. It also has lower volatility in its performance. That means it's ranked 1 even in the volatility parameter. It's a fairly diversified portfolio at the sector level, which means that it's again a rank 1 in terms of industry diversification. Now the fund is fairly large in terms of assets. It's a 50,000 crore portfolio, which means that its liquidity of the underlying portfolio is weaker, or it ranks lower in the liquidity parameter. When we look at its performance, it's outperformed the benchmark as well as the category across time frames. Some of the sector or the stocks in some of the sectors like auto, power, energy, they have positively contributed to its performance. When we look at Nippon Large Cap, this is a fund again which is ranked 1 continuously in the last 4 quarters. This is a fund again delivering return higher than the benchmark as well as category across time frames. When we look at parameters, it ranks 1 on performance, which is a major driver for its higher rank in the category. But when we look at parameters like liquidity, it is ranked 4, partially because of the large asset size that the fund has. It also ranks 5 on the volatility. Now, when you look at its allocation across capitalization, the fund has relatively higher allocation to small and mid cap compared to the category. While it maintains a 80% allocation to large cap, which is the category definition, Some of its exposure in mid caps and small caps have contributed positively to its performance. Apart from that, sectors like construction, capital goods, and power are some of the positive sectors from its performance perspective.
All right. I do want to focus on the bottom three funds as well, because it's important to talk about underperformance equally when you speak about outperformance, right? And just like the top three have remained constant for some time, the bottom three have also remained constant. Axis Blue Chip, LIC MF Large Cap Fund, and Mirae Asset Large Cap Fund are in the bottom percentile of large cap actively managed funds. Why is that, Piyush?
Right. So when we look at Mirae, this is a fund which has been ranked 5 in the last 3 consecutive quarters. And even before that, the fund was ranked 4. So to that extent, the fund performance has been weaker across time frames. It ranks 5 lowest in the rank in the category as far as the return is concerned. Some of its exposure in the mid cap space and also some of the sectors like financial services and IT is where the fund has lost out in terms of performance. When we look at uh, LIC large cap fund, this is a fund again which has remained in the bottom percentile, bottom 10 percentile for the last 4 consecutive quarters. The fund ranks lower on the return parameter, and also in the portfolio based parameters, it is either 3 or 4 or 5. When you look at the performance, while fund has a large cap bias, some of its exposure in the small and mid cap space and sectors like IT, pharma, and chemicals is where the fund has lost out in terms of performance.
I want to move next to the Flexi Cap category, which is a pretty popular category. And the reason I want to talk about it immediately after the large cap is because of the tendency of these schemes to be more orientated towards the large cap category. In the top two rankings, you have, again, consistent performers in the way of Bank of India Flexi Cap Fund and JM Flexi Cap Fund. What has worked for these, Piyush?
Yeah, so JM and Bank of India, there are relatively smaller size funds in the category. JM is ranked 1 in the last 4 consecutive quarters. Its rank 1 is primarily driven by its performance, where it is ranked 1 on return parameter. Even on portfolio based attributes, fund is fairly diversified at a sectoral level as well as at a company level. With its lower asset size, the fund also scores high on the liquidity parameter. Bank of India is a fund which is been ranked 1 in the last 2 consecutive quarters. When we go into the further history, it was ranked 2 in the earlier 2 quarters. It is also a relatively smaller size fund with approximately 600 crores of assets. Fund scores high on return. It has outperformed the benchmark and the category across time frames. However, the fund has relatively higher volatility compared to the peer set, but it's a fairly diversified portfolio at a company level and is ranked 1. Some of its bet in PSU sector, PSU banking sector, financial services, power sector stocks have played favorably in terms of its performance.
Got it. Now, in the last two, we've got Axis yet again, the Flexi Cap Fund and the UTI Flexi Cap Fund, which have underperformed. Why is it that these schemes have underperformed? And is it because of the relative underperformance of the returns compared to peers, or is it more than that?
Yeah, so return is one of the primary factor for their lower ranking in the category. UTI, for instance, has remained 5 in the last 4 quarters. It ranks 5 in the return parameter. Even on the portfolio-based parameter, UTI with its asset size of 25,000 crore scores low on the liquidity. So performance as well as liquidity, lower liquidity score has contributed to its lower ranking in the category. When we look at Axis, Axis is a fund which has again remained in the lower ranking category for last 4 consecutive quarters. Its performance has remained weak over a period of time. It is ranked 4 in terms of return parameter. The fund also has traditionally maintained relatively concentrated portfolio, especially at a company level, which means that some of the stocks where the fund has higher exposure and which have also not performed in terms of return has adversely impacted its overall ranking. Its ranking on the liquidity parameter is also weaker with its 11,000 crores of assets.
Got it. I want to move now to the mid-cap space where you've seen quite a bit of churn, and there's a new fund that makes it to the list right at the top, ITI Mid-Cap Fund. Motilal Oswal Mid-Cap Fund is ranked 1. It was ranked 2, or rather in the next category in the previous quarter, and Quant Mid-Cap Fund is also breaking into the top percentile. What's worked for these?
Yes. So ITI is a fund which has completed 3 years of its performance, and hence it has entered into the ranking in the latest quarter. The fund is ranked 1 in this particular quarter. It scores high on the returns. With its lower asset size, it scores high on the liquidity parameter also. Fund is a fairly diversified portfolio at a company level and is ranked 1 even on that parameter. Some of the stocks in large cap, PSU space, financial services, capital goods have positively contributed to its performance. When we look at Motilal Oswal, this is a fund which has seen improvement in ranking compared to the previous quarter. It was ranked 2 in the earlier quarter. Even before that, when we look at earlier quarters, it was ranked 1. So to some extent, the fund has remained in the rank 1 or rank 2 category in the last 4 quarters. The fund performance in the ranking is primarily driven by its returns. It is ranked 1 on return parameter. Having said that, the fund has a relatively concentrated portfolio, ranked 5 on the concentration parameter. Some of the stocks in energy, auto, IT has contributed positively to its outperformance.
All right.
Quant mid-cap, just like all the quant funds that we have seen in the equity category, it's a portfolio which has a relatively higher churn in its portfolio. The fund has been ranked 1 in the latest quarter. Prior to that, the fund was ranked 2. Some of its stock selection bets have continued to play positively for its outperformance, and it has remained outperformer across time frames.
Let's quickly run through the laggards and then move to the last category of mutual fund schemes. But in mid-cap, you have DSP mid-cap, PGI India mid-cap, as well as UTI mid-cap that have underperformed. Why briefly has this taken place?
Yeah, so DSP, when you look at its ranking, it has declined from rank 4 to rank 5. When we look at parametric-wise ranking, its decline in its return parameter has meant that its ranking has declined. It was rank 4 in the previous quarter. It has come down to rank 5. Its exposure to some of the stocks in consumer discretionary has adversely impacted its performance. It also scores lower on the liquidity parameter and company concentration parameter.
Got it.
When we look at PGIM again is a weaker performer in terms of ranking. It's ranked 5 in the last 3 consecutive quarters. Its lower ranking in return parameter and relatively lower ranking in liquidity parameter has impacted its overall ranking in the category. And third being UTI. UTI is a fund which was ranked 4 in the previous quarter. However, it has slipped to rank 5 in the latest quarter. Fund scores low even on the parameters like industry concentration and liquidity. While it is a fairly diversified portfolio at a company level, some of its exposure into consumer discretionary healthcare stocks have adversely impacted its performance.
Yeah. Piyush, let's quickly run through the small cap winners and the losers. On the winner side, you have Bandhan as well as Quant. What's worked here?
Yeah, so Quant small cap is a fund which has seen improvement in its ranking in the last 3 quarters. The fund was ranked 3, in fact, 3 quarters back. It has gradually come up to rank 2, and now in the latest quarter, it is being ranked 1. If you look at quant funds across equity category, they follow a strategy of high portfolio churn with a concentrated portfolio, and some of its bets at a stock selection well level has worked, and which has meant that the fund is ranked one. When you look at Bandhan, again, this is a fund which has seen improvement in its ranking in the last 4 quarters. The fund has improved from rank 4 quarters back to rank 1 in the latest quarter. Its performance being the primary driver. Apart from returns, it also scores high on company concentration parameter, thereby ranks higher in the overall ranking.
Absolutely. And on the underperformers, you have Aditya Birla Sun Life Small Cap as well as UTI Small Cap. Unfortunately, Piyush, we're running out of time on this particular segment. But thank you so much for joining in and for giving all of the analysis that you give. I'm sure that's going to be useful to a lot of people out there.
Thank you, Alex.
Nisreen Mamaji is joining in to talk about how you should go about choosing the scheme in this category. Nisreen, thanks so much for taking the time. Now, this was a classification that was done a few years back by the Securities and Exchange Board of India because they found that multi-cap funds were not being true to label. How do you rate the way that these schemes are currently being managed, and how many, according to you, are truly Flexi Cap in nature?
So basically, I'll just, explain what is the difference between a Flexi Cap and a multi-cap before we continue with that discussion. So a Flexi Cap fund doesn't have any mandate to be in a particular market cap. So it can be, 60-70% in a large cap if the market conditions are, as they are right now, and they can reduce their mid and small cap exposure. A multi-cap fund, on the other hand, has to be mandated to be 25% in large cap, 25% in mid cap, 25% in small cap, and the balance 25% will be as per the discretion of the fund manager. So in that sense, a Flexi Cap fund manager has much more discretion of his own to decide whether he wants to be 100% in large cap and say, maybe 0% in the others, or he can even select a 70% in a large cap, 30% in mid cap, and 0% in a small cap. So there is much more flexibility with a Flexi Cap fund manager, and as the conditions prevail today, since the mid caps and the small caps have already run up to a large extent, a Flexi Cap fund manager can reduce his exposure to mid and small, and make sure that for the next 2 or 3 years, his fund may outperform a multi-cap fund. So these are the basic differences between a Flexi Cap and a multi-cap fund.
Got it. All right. Now, how do you judge the performance of these schemes? I ask because in a market that is doing well, that is running up, you see outperformance in the form of stock selection that is aided by that bullish trend. But do you also pay attention to underperformance and portfolio protection or downside protection, because these schemes ultimately should be offering that?
So definitely, in a 100% large cap fund, basically, the investor horizon has to be 3 years upwards. So whether it is Flexi Cap or whether it is multi-cap or even a large cap, it's very difficult for the investor to be in an equity fund and at the same time ensure that you're protecting your downside. What you can do is make sure that your tenure is longer, okay? Because no fund manager can protect downside like what happened in 2020. Suddenly in that year, there was obviously, a cataclysmic effect, and suddenly overnight, all the NAVs have dropped, and there was obviously, for some people who were newly invested and for people who had been invested for 2 to 3 years also, they might have seen a loss in principal as well. So when you are an equity fund investor, you have to make sure that your horizon is at least, 5 years upwards, between at least averagely 4, so that you can withstand the volatility and protect the downside as well as have an expected return on investment over a longer period of time. So that is one thing that the investor has to make sure that you are there for the longer term. If you are a shorter term investor, say for 1 to 3 years, then there are a range of dynamic asset allocation funds that you can, be an investor for. You have the equity savings fund, you have balanced advantage funds, you have dynamic asset allocation funds, you have asset allocator funds, you have multi-asset funds. So if your tenure is shorter, then, it would be advisable for you not to be in a 100% equity fund like a Flexi Cap or a multi-cap or even a larger mid cap.
Okay, having said that, very quickly, before we move to a few of the queries that have come through, Nisreen, are there any schemes and managers that you have paid close attention to, that you have followed and that you like?
Basically, we do recommend Parak Flexi Cap Fund, HDFC and Franklin Templeton, not only for the performance, but for the consistency over various periods of time, and also for the value that the AMC brings to the table. So it will be Parak Flexi Cap, which is a very long-running Flexi Cap, Franklin Templeton, and HDFC Flexi Cap as well.
Got it. Let's move quickly to the questions that have come through. The first one's from Anuj. He says he's 40 years old. He's asking, is it better to create an emergency fund in a high-yield saving account with 7% return, or to buy a liquid fund for the long term? He wants to move 20 lakh invested from regular mutual funds to direct funds, and he's wondering about the tax implications and the market conditions. What would you say about these two questions, Nisreen?
Sure. So, Anuj, the query depends on basically how long you're planning to hold the emergency funds for. Because in a liquid fund, the average return would be, post expenses about 6.7 to 6.8% post expenses in a direct option. In a regular option, it will be around 6.5. So if you're comparing between, a liquid fund where you're earning about 7% return on investment, and in a liquid fund where you would be earning about, say, between 6.5 to 6.8, it depends on the tenure. If you're holding it longer, then you can get advantage of the interest rates moving down, in which case the yields will go up. Okay, so you have to keep that in mind. Also, your own marginal tax rate, which will be, applicable for both your savings account and a liquid fund. What I would recommend is that you look at arbitrage funds presently, because you will get the benefit of equity taxation on that. As at the same time, the current, spreads are around 7.5 to 8% annualized. So that option you haven't mentioned, but I think for an emergency fund, which you're holding for about 6 months or longer, you can look at, beside the savings account with a high yield savings account or a liquid fund, you can look at an arbitrage fund. Also, once you've established your emergency fund, you will be holding that for a longer period of time. So, it's basically 6 months of expenses. So neither of these options also suit you, because once you've established that, if you're doing an SIP, then yes, either of these options are fine. Once you have the lump sum, you can easily be in any dynamic asset allocation fund. You can be in an equity savings fund. Yeah. You can be in a BAF or a multi-asset fund. Because you can withdraw from it anytime.
Yeah.
The second part of your query is regarding, whether you want to move from a direct option to the regular option. So remember, on the books, it will be a sale. So you have to sell out of the direct funds and purchase the, sell out of the regular funds and go into the direct funds. So you'll have to book your profits and pay the taxes. Okay. And after that, you will, it's like a fresh start. So if you're mentally prepared to do that, then of course it would be a good option, and then you can continuously review the direct fund returns.
Yeah, and if you're holding for a long period of time, then it certainly makes a lot of sense. The second question, and the last one that we'll take today, is from Sheetal Gonzalez. She's got 8 lakhs that she wants to invest into mutual funds, and she's got two primary goals. One is her daughter's education that she'll need after 8 years, and a retirement fund for her husband in 10 to 12 years. Could you suggest a few schemes, Nisreen?
Sure. So for her daughter's education, I would recommend a Flexi Cap fund, which is Motilal Oswal Flexi Cap fund, a Bandhan Core Equity Fund for the large and mid category. So Motilal, we can put in about 2 lakhs. Bandhan Core Equity, we can put in about 150,000. And ICICI Pru India Opportunities, where we can also put in about 150,000. So the future value for the daughter's education after 8 years at about 13% return on investment or compounded annualized growth rate would be around 13.3 lakhs. And for a husband, which is, who's going to retire about 10 to 12 years down the road, we would recommend ICICI Pru Business Cycle Fund, which is a sectoral thematic kind of a fund. And there she can invest about 3 lakh rupees. And at about 15% compounded annualized growth rate, she can expect about 16 lakh rupees at the end of 10 or 12 years.
All right,
fantastic. So this is the asset allocation.
Absolutely. Thanks so much, Nisreen, for getting us those questions answered, and indeed for the conversation that you had with us on Flexi Cap funds. That brings us to the end of this particular edition of the Mutual Fund Show. Let us know what you think in the comments, and do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.